Tyler, it's looking more likely that the Fed is finally going to cut interest rates potentially this month, the month of September, when they have their next meeting. And that could be great for a lot of consumers, especially in things that you use a lot of debt to buy, like real estate. Could be really good for businesses in real estate too. So we've got some companies we're going to talk about right here. There's three that we're going to discuss, see if we can reach a conclusion. Are these three stocks you should buy before the Fed cuts interest rates later this month?
It's something we've been tracking for a while. It's like we've been waiting for a long time for interest rates to come. And the theory being there's could be quite a few companies that would benefit a lot, and then some maybe a little bit. Who knows?
Okay, let's dig into it. Before we get to it, though, I'm Jason Hall. This is Investing Unscripted. That is Tyler Crow. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should go to our special link. You see it right there on the screen. It's fool.com/unscripted. Again, fool.com/unscripted. Go to that link. You can get access to The Motley Fool's 10 best stocks to buy right now. It's worth your time. Go check it out. There's some incredible ideas there. You can really skill up your own investing game. Okay, Tyler. So just really quickly, where we've gotten with interest rates. Of course, the Fed, we saw some nearly historic levels of interest rate increases back, I guess, almost a couple of years ago at this point, a year and a half ago. And there's been this expectation for some time that the Fed was going to start gutting rates. And it hasn't happened. And essentially, we've seen a couple things happen. Number one, inflation has gotten essentially under control at this point. I think it's fair to say inflation's under control. But the reason the Fed has been slow to cut rates is because the economy stayed relatively healthy, and lowering interest rates is one of the Fed's most valuable tools to stimulate the economy, right? And until we saw the Fed sees a clear need to try to act to stimulate the economy, particularly on the job side, the Fed hasn't felt a need to cut rates. But the jobs data is starting to get a little bit softer. Unemployment might be starting to creep up. Economic activity clearly slowing down in certain areas, especially some discretionary spending areas of the economy. And of course, consumer spending is such a big part of the economy. So it looks like we're there, maybe not for great reasons, but real estate, we know, especially residential real estate, that's an area where there's a lot of pent-up demand. Interest rates coming down, especially as we're seeing inventory start to open up, that could be a real positive. What are some companies that we think could benefit here?
Yeah, I'm a little bit of two minds with the interest rate cut thing of how much it's going to be a degree of a benefit. For example, one of the reasons that the housing market has been so stuck for so long is that there are a lot of people with much lower mortgage rates than what are available today. There's people with mortgages less than 3%, and there's enough current mortgage rates today are somewhere in the 5.5 to 6% range. It's going to be really hard for somebody with that kind of mortgage to move. So that's why we've seen like this really stuck housing market lately, and a decline in mortgage rates will help. I don't know if it's the panacea, but I think you'll definitely start to see some more stuff coming to market because people are going to be a little bit more interested in buying, which in theory should also bring some more people to the table. One company that I think we've talked about before, I've certainly talked on other channels, is Opendoor Technologies. They are what's called an iBuyer, which basically is the idea of instead of you selling directly to another homeowner or buying from another homeowner directly or through an agent, you would sell it to the company directly and they would warehouse it on their books and then sell it, trying to speed up the process for a lot of people, especially somebody who needs to sell quickly for per multitude of reasons. And having a good inventory of homes obviously is going to bring buyers to the table. There's this network effect sort of feel to it.
The idea,
One,
right, is you're basically taking house flipping and you're scaling it up,
yeah,
creating an infrastructure to be able to do lots of them. Typically, people, businesses that do house flipping, they know a market really well. Maybe a couple markets they know really well. Open Door's goal is to be in multiple geographies, be in different areas, and to do it at scale, right? So they can
yeah,
generate leverage to do it.
yeah, and using pricing algorithms to try to determine like houses they can buy at
Right.
certain prices that they
Adding
can
that
make.
tech layer on it, that if you're a small operation with a couple of employees and 30 contractors on your speed dial, you probably don't have an algo that's helping you determine market pricing.
And so in theory, it makes a lot of sense. It's struggled to do it because it's relatively low profit margin business, and so you have to get it just right. And that's where I think Opendoor has struggled a little bit. It started off in this go growth mode, was buying houses probably at a too high of a price and was taking considerable losses on them. Under new leadership that came in towards the end of last year, they've gotten their pricing models fixed and have been a little bit more prudent about what they want to buy, which is great. And you're starting to see some profitability creep in, and gross margins are picking up. Something that they call contribution margin is starting to get to a better level. The thing that's going to be the big determinant for them and why interest rates could help is that one of their biggest costs is interest rates, or sorry, interest expense, because when you basically they don't have the cash sitting around to just buy houses from these people and then hold them on the books. They use debt to finance that. And every day that a house sits on their books, it basically declines the profitability on that house because you have to pay interest rates. And so the theory being is that lower interest rates will lower that cost a little bit. But at the same time, if we see an uptick in housing activity, they can turn houses on their inventory faster, which would lower interest expenses and get it closer to profitability. That's the theory. If that does happen, it could work. The challenge is we haven't yet seen it, and so we haven't actually seen Net Opendoor get to net profitability. So when it does, or not when, if it does, it could be a huge winner, but it's kind of a high risk sort of endeavor.
I'm going to share on the screen here a chart because I think we have to look back at the history of the company. I think it's important. There's two things on the chart here. There's revenue, that's the purple line. And then this is existing single family home inventory, because this is directly tied to their ability to find inventory, to find houses to sell. So you see, this is when they went public. And of course, anybody remembers, this was the boom period for existing home sales. Like, it absolutely skyrocketed during this period. Now, that was preceded by a period of higher inventory than we have today, right? Now, this is seasonal ups and downs that we see. Just less homes are listed in the winter. So that's a seasonal decline that we see. But again, the point is that as the revenue has come down, inventory has come down a lot, but also interest rates, again, started to spike right in here. I want to overlay this with something really, really important. You talked about financing those homes. Just to clean up the chart a little bit, I'm going to pull the home inventory data off. And you can see when the company went public, it also began taking on a substantial amount of debt. And that debt level has come down along with the revenue because they sold off massive amounts of inventory to try to bring that debt down. This is not a business that carries a lot of cash. It's trying to be as capital efficient as it can. And again, using debt in the short term to acquire those properties, quickly prep them for market, and then flip them as quickly as it can is the goal, right? To try to be as capital efficient as possible. Like Tyler said, in theory, you could definitely be a big beneficiary, both for itself, for its cost of capital, but also increasing the pool of potential buyers. Both of those things could be beneficial. We're going to find out how well it works. Let's talk about Redfin, Tyler. That's another one that clearly is positioned to benefit from lower interest rates. Particularly, as I showed on that chart, we saw that little uptick in existing inventory. The more homes that are listed, Redfin, this is basically a broker. Their business is listing and selling houses. That's how they make money on a national scale, right? They're in a lot of markets in a lot of states. So it's a volume game for them too. Interest rates don't help them on the cost of capital because they're not buying the houses, they're listing the houses. But it should make it cheaper for more people to be able to buy a house.
Yeah, you can almost, I know I'm overgeneralizing here a little bit, but you can lump anybody who is a real estate broker or a technology company looking to disrupt real estate brokerages as beneficiaries, because basically they've all been kind of bets on the directions of housing sales. And if housing sales go up, obviously you get more revenue, which obviously should lead to better profitability. So we could talk about Redfin here. We could talk about Zillow, even though they're not technically a realtor, they are a lead gen for
Kind of an
realtors.
aggregator, right? Giving
Yeah,
people access to find properties, to find realtors, to find lenders, to find inspectors, like all of those things, right? It's almost like an ad-based business model as much as anything.
yeah. So any of these businesses where you see some uptick in housing, which again, going back to the interest rate thing, we're playing this on the idea that lower interest rates is going to unstick the housing industry. If we were to see a significant uptick, we haven't seen it yet. I should be clear here. Mortgage rates have come down. We haven't seen it yet. This is the theory that it could happen in the coming weeks or months is interest rates come down. But both Zillow and Redfin, stocks wise, have been way down because revenue is down. Both companies have done a lot to cut costs, try to live within a much more slower real estate interest world. I know that CEO of Redfin, Glenn Kelman,
Mhm.
has had some very aggressive words on how they want to cut costs and make sure they get everything back to profitability. It sounds like that's where they want to go. But again, same thing with Opendoor. These are all theoretical at this point. And so like you could see it as a catalyst and as potential to buy before. But I do want to make the clear point here that this is kind of a speculative idea. This is not something that we're tangibly seeing in the data yet from housing market.
Yeah, the one thing I do want to say about Redfin that I think is worth mentioning is that Redfin and Zillow both made their goes at being iBuyers as a side business on top of their existing core real estate businesses that they have. And both have exited those businesses when interest rates went up. They went into them when cost of capital was super cheap. And then when interest rates skyrocketed, both very quickly pivoted and exited. Redfin's made some big steps to cleaning up its balance sheet, reducing leverage, reducing some potential risk of insolvency with its balance sheet. The balance sheet's in decent shape now and revenue has stabilized. I think that's a really good starting point for Redfin. The last one I want to throw in there, and this is one that I'll be honest with you, I haven't done a lot of research more recently, but it's a big real estate brokerage business in residential and also commercial real estate. And then they do some lead gen businesses as well and some other things to help people market themselves and develop themselves professionally. And that's EXP World Holdings. It's been around for a long time. It's a lot bigger than Redfin, but that kind of real estate brokerage agency business is a big part of their business as well. So if you're thinking about companies in the short term that can benefit from these trends, and EXP is a business that has shown profitability over the long term and done pretty well. So I think I would put EXP in that conversation as well. Of course, you have to do your own due diligence on all of these, but that one especially, don't take my word for it at all. You need to dig in a little bit more. There's some good long-term success there.
This is something we've been waiting for a long time, cutting interest rates, kind of getting the housing market back up to snuff or back to a more normalized rate. It hasn't yet happened yet, but there is maybe an opportunity with some of these companies to get in a little bit early before we actually start to see this increase in housing.
Last thing I want to say, when the Fed starts doing things like cutting rates, they're trying to thread a needle here. And that needle is not doing it too soon where you overstimulate the economy, gets too hot again, inflation rears its head again, and we're back to fighting that war. The goal is to keep the economy healthy, and you wait too long, you get recession, right? And the risk here is if we're too far down the track of the economy getting weak, you know what's really bad for real estate, Tyler? Recessions, right? So you have to be thoughtful in the near term. I think long term, if the thesis plays out for any of these stocks, and of these, the one that I'm the biggest like thinking about the speculative opportunity, I like Redfin. I think that model scales better. It's more capital efficient. Opendoor, that's just we haven't seen anybody be able to show that they can really effectively scale it and generate cash flow. So I think if you're thinking speculatively and you're willing to go through a short-term period where maybe it gets ugly if we actually do see recession, but longer term, you just have to invest through that period to get back to the upside on the other side. You just have to be thoughtful about that.